I'm staring at the most deceptive monetary policy announcement in years. And if you missed what happened on December 12th, you're about to discover why the Federal Reserve just restarted the money printing machine while pretending they're not printing money at all. They're calling it reserve management, but I'm here to tell you it's the same old quantitative easing with a prettier name. The Fed just committed to purchasing $40 billion in Treasury securities every month starting December 12th, with no end date specified. That's $480 billion annually in new money creation injected directly into the financial system. But here's the truly disturbing part. They're doing this while simultaneously claiming they're fighting inflation and maintaining restrictive monetary policy. Let me walk you through exactly what happened and why every American taxpayer should be concerned. On December 10th, the Fed announced the end of quantitative tightening and the immediate restart of Treasury purchases. They claim this is purely technical, just routine reserve management to ensure adequate liquidity in the banking system. But the economic effects are identical to the quantitative easing programs that inflated away your purchasing power over the past 15 years. Here's their official justification. They need to maintain ample reserves in the banking system, especially with the April 15th tax season approaching. Powell explained that when people pay taxes, reserves drop temporarily, so they need to build up liquidity in advance. It sounds reasonable until you examine the numbers and realize this is a permanent expansion of the money supply disguised as temporary technical adjustments. The repo market stress Powell referenced is real, but it's stress the Fed created through their own policies. They spent 3 years shrinking their balance sheet from $9 trillion to $6.6 trillion, deliberately draining liquidity from the financial system. Now they're claiming they went too far and need to reverse course. But here's what they're not telling you. This reversal will likely be permanent, and the scale will likely expand far beyond the initial $40 billion monthly. I've been analyzing the Fed's balance sheet operations since 2008, and this pattern is always the same. They start with limited and temporary programs for technical reasons. The temporary becomes permanent. The limited becomes massive. The technical becomes openly stimulative. We saw this exact progression with QE1, QE2, QE3, and Operation Twist. Now we're seeing QE4 disguised as reserve management. But there's a more fundamental issue here that should terrify every American who pays taxes, owns a home, or tries to save money. The Fed is creating new money at a rate of $40 billion monthly, while inflation remains at 2.8%, well above their 2% target. They're adding liquidity to an economy that already shows clear signs of overheating in asset markets, while claiming they're committed to price stability. Let me explain how this money creation actually works and why it matters for your financial future. When the Fed purchases Treasury securities, they create money electronically, literally out of nothing, to pay for those bonds. This new money enters the banking system as reserves, which banks can then lend out to businesses and consumers. More money in the system means higher asset prices, lower real interest rates, and ultimately, higher consumer prices. The $40 billion monthly figure is not small. To put in perspective, that's more than the entire GDP of most US states. It's equivalent to the annual economic output of Oklahoma or Oregon. The Fed is creating new money equivalent to an entire state's economic production every single month, with no corresponding increase in goods and services to absorb that liquidity. But here's where the deception becomes particularly egregious. The Fed announced this money creation on the same day they cut interest rates by only 0.25% and projected just one more rate cut for all of 2026. They want to appear hawkish on inflation through limited rate cuts while simultaneously flooding the financial system with unprecedented liquidity through asset purchases. The repo market justification doesn't hold up under scrutiny. Repo rates had been rising, indicating tightening liquidity conditions. But that's exactly what the Fed wanted when they implemented quantitative tightening. They deliberately drained liquidity to reduce inflation pressure. Now they're reversing course at the first sign of market stress, revealing their true priorities: asset price stability over currency stability. The April 15th tax season excuse is equally misleading. Yes, tax payments temporarily drain reserves from the banking system. But this is a predictable seasonal phenomenon that the Fed has managed for decades without permanent balance sheet expansion. They could address seasonal liquidity needs through temporary repo operations rather than permanent Treasury purchases. What's really happening is that the Fed is responding to pressure from financial markets and political forces rather than economic fundamentals. Asset prices declined modestly when liquidity tightened. Bank profits face pressure from compressed net interest margins. Political pressure mounted for easier monetary policy. So they're reversing their restrictive stance while maintaining the pretense of inflation fighting. The timing reveals their true motivations. Why restart money printing now, when inflation remains elevated and employment is still relatively strong? Because they're prioritizing financial stability over price stability, market confidence over currency confidence, short-term growth over long-term sustainability. I want you to understand what this means for different types of Americans. If you own financial assets, stocks, bonds, real estate, you'll likely benefit in the short term as this new liquidity flows into asset markets. The wealthy who hold disproportionate amounts of financial assets will see their wealth increase faster than inflation erodes it. But if you're a wage earner, a retiree on fixed income, or someone trying to save money for a home purchase, you're about to get hit with the hidden tax of inflation. This new money creation will bid up prices across the economy while your income fails to keep pace. You'll pay more for housing, food, energy, and basic necessities while the purchasing power of your savings erodes. The international implications are equally concerning. The dollar's status as the world's reserve currency depends on confidence in American monetary policy. When other countries see the Fed restarting money printing while claiming to fight inflation, it undermines trust in dollar-denominated assets. Foreign central banks may accelerate their efforts to diversify away from dollar reserves. China has been reducing its Treasury holdings for years. Japan, traditionally America's most reliable creditor, has been selling treasuries to support the yen. European central banks are maintaining more diversified reserve portfolios. The Fed's return to money printing accelerates these trends by confirming that American monetary policy prioritizes domestic political convenience over international monetary stability. The corporate sector is already positioning for this liquidity injection. Companies with significant debt burdens will benefit from lower real borrowing costs. Leveraged buyout activity will likely increase as cheap money becomes available again. Share buyback programs will accelerate as companies use the new liquidity to boost stock prices. But the productive economy faces different dynamics. Small businesses that don't have access to capital markets won't benefit from Fed liquidity injections. Manufacturers dealing with tariff-induced cost increases won't see relief from monetary policy. Workers competing with immigrant labor restrictions won't see wage benefits from easier money. The housing market provides the clearest example of how Fed money printing affects ordinary Americans. This new liquidity will flow into mortgage markets, potentially reducing rates slightly. But it will also inflate home prices faster than most families can save for down payments. The net effect benefits existing homeowners at the expense of potential buyers, another wealth transfer from young to old, from renters to owners. The commercial real estate sector faces even more dramatic effects from renewed money printing. Office buildings, shopping centers, and apartment complexes will see artificially inflated valuations as investment capital seeks yield in a low-rate environment. This creates bubbles in property markets that ultimately collapse when monetary policy inevitably tightens, but not before ordinary Americans pay higher rents and face reduced housing affordability. Real estate investment trusts, REITs, and other property-focused investment vehicles will attract substantial capital flows from this Fed liquidity injection. Institutional investors, pension funds, and wealthy individuals will bid up these assets while working families struggle to afford basic shelter. The Fed's money printing creates a systematic transfer of wealth from wage earners to property owners. Agricultural markets face similar distortions. Easy money tends to flow into commodity speculation, inflating food prices. Farmers benefit from higher crop prices in the short term, but they also face higher input costs for fuel, fertilizer, and equipment. Consumers pay higher grocery bills while farmers' real profitability remains uncertain. The global commodity complex will see significant price increases as dollar liquidity flows into international markets. Oil, copper, and agricultural products typically rise when the Fed expands monetary policy. Manufacturing companies face contradictory pressures, lower borrowing costs, but higher input prices for materials and commodities. The technology sector will likely see renewed investor enthusiasm as cheap money flows into growth stocks. Large technology companies with strong balance sheets will benefit disproportionately. Energy sector dynamics become complex during Fed money printing cycles. Traditional energy companies may see stock appreciation from commodity increases. Consumer discretionary spending patterns will shift as Fed money printing affects different income groups differently. High-income households that benefit from asset price inflation will increase spending on luxury goods, while middle and lower-income families face reduced purchasing power. Credit markets will see significant changes as $40 billion monthly flows through the banking system. Corporate bond yields will decline, encouraging additional business borrowing and leverage. High-yield bonds and emerging market debt will attract investment flows seeking higher returns in a low-rate environment. The pension fund and retirement system implications are particularly troubling. Public pension funds that are underfunded will see temporary relief as asset prices rise from Fed liquidity. But private individuals saving for retirement face eroded purchasing power from the resulting inflation. The Fed's money printing essentially taxes future retirees to bail out current institutional investors. Social Security recipients face wealth transfer through Fed money printing. While benefits receive cost of living adjustments, these lag behind actual price increases, making retirees unwilling subsidizers of asset bubbles they cannot participate in. State and municipal governments experience mixed effects, lower real borrowing costs, but higher costs for goods and services as inflation accelerates. The insurance industry faces complex dynamics. Life insurers struggle with low rates, reducing investment returns while long-term obligations remain fixed. Small business lending becomes more available, but real costs may increase as inflation accelerates. Labor markets experience distortions as financial sectors see wage increases while manufacturing and service sectors struggle with rising costs. Educational institutions with large endowments benefit from asset prices but face increased operational costs passed through to students. International implications include dollar weakness affecting trade relationships and forcing global central banks toward monetary debasement. Emerging markets with dollar debt face acute pressures from U.S. policy shifts. Let me address the Fed's claim that this is somehow different from previous quantitative easing programs. They argue this is purely technical reserve management, not economic stimulus. But money is fungible. It doesn't matter what label you put on newly created dollars. $40 billion in monthly Treasury purchases has the same economic effects, whether you call it QE, reserve management, or monetary accommodation. The ample reserves framework they're using is inherently inflationary. It means keeping excess liquidity in the banking system at all times, even when economic conditions don't warrant monetary accommodation. This creates a structural bias toward easy money and asset price inflation at the expense of currency stability. Here's what I expect to happen over the next 6-12 months. Asset prices will likely rise as this new liquidity flows into financial markets. Stock indexes will probably reach new highs. Real estate values will continue climbing. Cryptocurrency and other speculative assets will see renewed interest from investors seeking yield in a low-rate environment. But consumer prices will also accelerate. The Fed's own projections show inflation remaining above target through 2027, and that was before they announced this money printing restart. Food, energy, housing, and service prices will likely rise faster than wages for most American workers. The most concerning long-term effect is the precedent this sets for future monetary policy. The Fed is essentially admitting they can't tolerate any significant tightening of financial conditions without immediately reversing course. This creates moral hazard in financial markets and reduces the Fed's credibility as an inflation fighter. My recommendation for ordinary Americans is to position for the inevitable consequences of renewed money printing. This means holding real assets that maintain value during inflationary periods while avoiding long-term fixed income instruments that lose purchasing power. It means building skills and career flexibility to adapt to changing economic conditions. But most importantly, it means understanding that the Federal Reserve's primary allegiance is to the financial system, not to ordinary Americans. When they restart money printing while claiming to fight inflation, when they prioritize market stability over currency stability, when they use technical language to obscure political choices, they're revealing their true priorities. The $40 billion monthly money printing that started December 12th isn't temporary, technical, or targeted. It's the resumption of the same monetary policy that has inflated asset bubbles, eroded middle-class purchasing power, and increased wealth inequality for the past 15 years. The only difference this time is the marketing language they're using to justify it. This isn't monetary policy, it's wealth redistribution, disguised as technical adjustments. And every American taxpayer who works for wages, saves money, or lives on fixed income will pay the price through the hidden tax of inflation, while those who own financial assets reap the benefits of artificially inflated prices. The money printer is back, and it's bigger than ever. The question isn't whether this will cause inflation, it's whether ordinary Americans will recognize what's being done to them before it's too late to protect themselves.